Good morning, everyone. Good morning. Welcome to our breakfast briefing at the RSA House, London. It looks like a magnificent event. I hope you'll enjoy it. My name's Alan Myers, and I'm the Regional Director of READ for Central London. Welcome here today for what I'm sure will be a very enjoyable morning with David. As you all know, last week, Jeremy Hunt delivered the presentation of the spring budget to the House of Commons. With the dust settling on this budget and the recent EU trade deal, there's much to discuss. We're here today to look at what this all could mean for your business, the economy and the wider marketplace. We're joined today by David Smith, who's the long-standing economics editor of the Sunday Times. And he's here for 40 to 45 minutes, and then he'll take any questions. That's all from me. Over to you, David.
Thanks very much, Alan. It's a pleasure to be here in this magnificent, great room. And I know the RSA a bit, but it's good to be here on this platform. I hope you can hear me, because my microphone's just dropped off, but I'm going to try putting it back on. Right. Is that any better? Yeah. Anyway, as Alan says, we were supposed to have this meeting a week ago, immediately after the budget. And then we had the train strikes. And budgets are a bit like Christmas. You know, there's a great excitement in the build-up to them, but they're very quickly forgotten afterwards. So I won't dwell too much on the budget, but I will talk about the outlook in more general terms. And the other thing is that I think we may be coming to the end of the kind of disruption that we've had from train strikes. It looks as though they're coming to an end, so we'll just be able to find out how bad the railways are without the excuse of the strikes. So anyway, it's good to be here. Well, what I wanted to do is talk about prospects. It is a time of uncertainty, and I think the way I think about the uncertainty is that if you look at the past 10 or 15 years, it really has been one thing after another. So we've had a series of events, a series of shocks, starting with the global financial crisis, 2008-9. Then we had Brexit and the Trump trade wars. Then we had the pandemic, of course. You know, most of us have lived through previous pandemics without really noticing them, but this one we did notice. And then we had the Russian invasion of Ukraine and the impact of that. And I often think of these as the equivalent of the four horsemen of the apocalypse. And I was taking part in a pub quiz just last night, and the question came up: can you name the four horsemen of the apocalypse? Not my four horsemen, but the four horsemen. And in case it ever comes up in a quiz that you're taking part in, I can tell you the answer. I knew three of them, but I didn't know the fourth. And the four horsemen, the biblical four horsemen, are war, famine, death, and conquest. Conquest is the one we didn't get. But anyway, mine are economic four horsemen, and I'll elaborate on them a little bit in a moment. Or you might call them a flock of black swans. These are real black swans here. And I'm not under any on any commission from the National Trust, but these are black swans at Chartwell, which is Churchill's former home in Kent. And I can recommend a visit. You know, it's very good. The point about all these shocks is that, you know, in newspapers and I suppose in business, we tend to move on. We think something has happened, and and things then move on. But each of these shocks has consequences. You know, Harold Macmillan famously said that the biggest challenge for any government, and I suppose for any business, is events. You know, things that come up that we don't expect, surprises that we don't expect. And each of these things I've mentioned, each of these four factors I've mentioned, have had longer-term consequences. So we look at, you know, firstly the long-term impact of the global financial crisis, and in the case of the UK, probably more so, but also than other economies, but also other economies. What happened after the financial crisis was that productivity growth, you know, the amount we produce per person or per hour that we work, GDP per hour worked, really stopped growing after the global financial crisis. So you see through thick and thin, 2% a year productivity growth pre-financial crisis, virtually nothing since then. So it flattens off completely, productivity growth stops. In the case of the Brexit vote, you also see a long-term consequence there. So if you look on the right of this chart, you see that business investment is growing quite well up to the point of the referendum in 2016. Then it flattens off, and then, of course, it falls during the pandemic before recovering. So we're just about now back to where we were at the time of the referendum in 2016. So we've lost 6 or 7 years growth of business investment, and it really did tail off quite dramatically after the referendum because of the uncertainty about whether we could attract inward investment, but also domestic business investment stopped growing, despite the apparent incentive of, at that time, a falling corporation tax rate. So business investment stopped growing. So that's been a long-term consequence. And in terms of the pandemic, you can think of many effects from the pandemic. We can think of in the job market, in the labour market, we can think of what's happened to the size of the workforce, for example, and I'll talk about that a bit in a moment. But I suppose the biggest visible impact of the pandemic has been the rise in government debt. So pre-pandemic, government debt was about 80% of GDP, 80% of national income. Post-pandemic, as a result of extensive government support, it's gone up by £400 or £500 billion, and debt, public sector debt, government debt, is about 100% of GDP now. So that is a direct effect of the pandemic. It lurched up as a result of all those support measures, as a result of the furlough scheme and all those things. And then if we look at the Russian invasion and the impact there, of course it's given us high inflation. We're still living with high inflation, as we saw with those figures yesterday. And I think the longer-term impact of this is going to be interesting to see, because on the one hand, as I'll explain in a moment, inflation is likely to fall quite sharply from where it is now. But I think confidence in the ability of the central banks, the Bank of England and others, to keep inflation down has probably been knocked quite sharply by this episode. You can't. The previous episodes in which inflation went above target, in 2008 and 2011, it went up to about 5% and quickly came down again to 2%. This time, it's gone up by much more. So even if it comes down, people will be wary, and businesses will be wary about whether inflation has been truly beaten this time and whether we can stay at that 2% target. So I think all these things, so even though they are more memorable than most budgets, they are still we still tend to think that's in the past. Let's move on. But the long-term effects of these things are there for some time. And of course, the question of the moment, and I don't really want this to happen, not just because a fifth horseman makes the analogy very untidy, but also because I hope we're not at the start of another banking crisis. I don't think we are. I think the problems at Silicon Valley Bank and the problems at some of the other smaller US banks are different from the problems at Credit Suisse, which led to its being taken over by UBS. But there is no doubt that there's a lot of nervousness around at the moment, and we have to, I think, accept that banks are much better capitalized, much safer than they were in 2008. We also have to accept the reassurances from the regulators and from the central banks that the procedures in place mean that the kind of wave of bank failures that we saw in 2008 are unlikely to happen again. But in the end, you cannot be entirely and completely reassuring about this, because banking, as you all know, is built on confidence. If people lose confidence, as they did in Silicon Valley Bank, and they want to get their money out, if you get a run on a bank, as we saw in 2007 with the run on Northern Rock, it's quite difficult to stop it. It's quite difficult to build. And once people get nervous about the banking system, as they were, bank shares were very rocky a few days ago. They've stabilized now. But I'm mainly offering reassurance, but you can never say never when it comes to banking. So it is built on confidence. But I do hope it's not a fifth horseman. Because that just makes it very untidy, But also, I don't, it's the last thing we want to see. That would be a kind of a real sort of Brenda from Bristol event. Brenda from Bristol was the woman who famously said, "Oh, no, not another one," when it came to a general election. And I would say, "Oh, not another one," when it comes to another big shock that affects the economy. So we have to hope, and I do believe that this is not the case. But anyway, let's see. So what is the outlook as we look forward now? I think the fourth of those shocks, the Russian invasion, really did knock us back quite sharply. It pushed up inflation, but also if you look at prospects for the world economy and you compare what, for example, the International Monetary Fund, the IMF, was saying at the beginning of 2022, when we didn't know that Russia was going to invade Ukraine, prospects for the world economy were pretty good. We'd had a good bounce back from the worst of the pandemic in 2021, and it looked as though we were in for a couple of years of very good global growth. A reasonable number to think about for the world economy is 4% growth, and we were heading for that and more, it appeared, both last year and slightly less this year. Advanced economies are going to do pretty well, but so was the rest of the world. And you now look at the picture in January this year from the same organization, you see a sharp downgrade in both what happened in 2022 and also prospects for this year and for next year. And in particular, it looks as though advanced economies like ours, like the G7 economies, most of the EU and so on, and other Western industrial economies, have been particularly hard hit by the effects of the cost of living crisis, by the effects of high inflation, by the shift from near zero interest rates to much higher interest rates. And of course, in these projections, the IMF said that UK was the only economy of, I think, the 20 it forecast, which would suffer a drop in GDP this year. So they weren't very cheerful about the UK, but they weren't cheerful about any of the so-called advanced economies. So things have changed quite a bit. And if we look at what's caused the trouble this time, it really is this energy price shock that we've seen very dramatically come through in the past year or so. We've seen something that wasn't expected pre-pandemic at all and wasn't expected during the pandemic. I mean, I used to talk to Rishi Sunak a lot when he was Chancellor, and we'd never seen anything like the furlough scheme in the UK. We'd seen its equivalent or similar in other countries, in particular Germany has had something like that, the ability to do something like that for about 100 years, but it was new for the UK. But the one thing he didn't expect, or anybody else expected, was that we would emerge from the pandemic with A, very low unemployment, and B, labour shortages. So the aim of the furlough scheme, by keeping people in touch, employees in touch with their employer, was that you could just minimise the damage. At the time when the furlough scheme was announced, there were predictions that unemployment would go to 12 or 14% of the workforce. 4 million plus people unemployed. We've never seen anything like that in the UK before. So the aim was just to keep it respectable, to keep it in single figures. If you keep it to 6, 7 or 8%, it would have been a great achievement. So emerging from the pandemic with 3.5% unemployment and severe labour shortages was entirely unexpected. And for the UK, the labour force, the size of the workforce, is about 1 million smaller than we might have expected pre-pandemic. About 300,000 of that is due to EU workers going home and not coming back, and we've had formal Brexit during this period. Most of it, as you know, is due to rising inactivity among UK nationals, people who are here all the time. Some of that is now unwinding. It's unwinding for young people, so inactivity among 18 to 24-year-olds has started to ease, and that's because some of them stayed in full-time education longer as a result of the pandemic. Some of them who were in full-time education and used to have a part-time job decided they didn't want to do that because their education and perhaps the social life of university had been disrupted so much by the pandemic. They wanted to make sure that they could fully experience the remainder of it. So that started to unwind, and more 18 to 24-year-olds are coming back. But in fact, inactivity among the over 50s, the 50 to 64 age group, is still going up at the moment. You know, and of course we saw a partial response to that in the budget with the lifting of the lifetime allowance, a few other measures. But this looks, you know, quite a difficult problem to solve, because it is not mainly because of early retirement, to which the lifetime allowance was intended to be a response. The people who cite early retirement as their reason for inactivity is actually no higher now than it was before the pandemic. You know, people ask, you know, why are you economically inactive? The predominant reason for economic inactivity and the rise in it is long-term sickness, both you know, physical sickness and mental health. So those are the issues that need to be dealt with. And you know, once people have dropped out of the workforce, you know, and it's quite a task. And you know, I'm sure our hosts here, Reid, you know, are engaged in that task of trying to get people back into the workforce who've left it. And it's, you know, it's quite a challenge. I don't think there was all that much for this age group in the budget, but you know, we can talk about that. We also saw, of course, the supply chain problems. You know, when the pandemic first broke in 2020, it looked as though that would be the main economic impact on countries like ours. You know, we saw the problems in China. Nobody, I think, in the early part of 2020 thought we would have lockdowns in European countries, including ours. But we saw that it would be more difficult to get stuff out of China because of the problems there. And those supply chain difficulties are easing now. They haven't completely gone away, but they are, you know, they're easing considerably. But that has been a big factor, and has contributed to the high inflation that we've seen. And of course, central banks are raising interest rates, and Bank of England may well do so again, you know, very shortly. So we look at the pattern for our economy over the past couple of years. What you see there is, this is monthly GDP, broadest measure of economic activity. And what you can see there is how different the impact of the pandemic and of the restrictions and lockdowns and the behavioral changes that the pandemic brought about compared with anything before. You know, back in, within that, you've got the financial crisis recession on the left-hand side there, which until the pandemic was the biggest recession in the UK since the Second World War. And, you know, we all remember the consequences of it. But you look at the lurch downwards that happened in 2020, and it is off the scale in terms of previous experience. So, you know, the first lockdown was announced on March 23rd, 2020. In the second quarter of 2020, the economy shrank by almost 20%, 19.5%. And the previous largest quarterly fall in GDP was 2.8% in the three-day week of 1974. So this was completely different to any previous experience. I mean, I think we knew that, you know, if restrictions and people's worries were the cause of the drop in economic activity, that once those restrictions were lifted, once people decided that they were safer to make, you know, with human contact again, you knew the economy would bounce back. And it did bounce back initially quite quickly. So normally it takes 3 years for an economy to get back to where it was before a recession for our economy. After the financial crisis, it took 5 years. This time we were within sight, within a whisker of being back to where we were within less than 2 years, because as the restrictions were lifted. You know, we had 3 lockdowns. First lockdown, extremely big hit to economic activity. Second and third, much smaller effects, because we got used to it. And we got, you know, the first lockdown, nobody really knew whether you could work at home effectively. All those things, you know, Zoom and Teams and all those things were developed quite quickly, you know, sort of 10 years of technological change in the space of, you know, just a few months. So by the second and third lockdowns, we were much more efficient at doing that, and the economic impact was much smaller. And we did bounce back quite quickly, but, you know, we're not quite there yet, as you will know, that, you know, the last bit of getting back to where we were pre-pandemic are still yet to be completed. Things have got tougher in terms of the, you know, I suppose the last mile of getting back to where we were. And I think one reason for that is that consumer confidence is extremely weak, and has been extremely weak in the last few months. I can tell you, without breaking too many confidences, that well, perhaps one confidence, that this indicator, which is produced by a company called GfK, will show a slight upward movement when it is published tomorrow morning. but it will still be among the weakest it's had. This goes back, this index of consumer confidence goes back to 1974. It's been done since 1974. For a long time, it was funded by the European Commission. It's funded differently now, as you might expect. So you think of that period from 1974, it includes 27% inflation in the mid-70s, includes 3 million people unemployed in the 80s and early 90s. It includes the banking crisis when we really didn't know whether the banks were going to survive or not. It includes the pandemic and enormous worries there. But consumer confidence in the last few months has been weaker than at any point during this entire period, in almost 50 years. So I think it was the disappointment factor of the cost of living crisis coming so soon after the impact of the pandemic. People had thought there would be, post-pandemic would be able to, if you'd built up any savings during the pandemic, you'd be able to spend them. Things will be back to normal quite quickly, instead of which we're hit by a cost of living crisis. And I think that's why consumer confidence has been so low. And it is, as I say, it's recovering a bit, but it is still historically very low. Businesses are more cheerful. Things have picked up again. Particularly after the mini budget last September, businesses got very depressed again, and were as depressed as they'd been during the pandemic. But things have picked up. Business confidence is definitely up now, and is definitely stronger than it was. So that is a positive sign. Consumers, households still need persuading that things are better. And of course, the latest inflation figures we had, which showed that inflation is still in double figures, will have done nothing in the long run to improve confidence. Only when inflation is falling very sharply will, I think, consumers and households feel better about things. It's easy to forget what we had a few months ago, and the mini budget with all its consequences. We were talking earlier about refixing a fixed rate mortgage, and I really feel desperately sorry for people who had to do that in the last few weeks of last year, when fixed rate, you remember the time when all those fixed rate products were withdrawn almost overnight when the mini budget happened, and things have settled down a bit now. We're still facing higher interest rates, higher mortgage rates than before, but not as high as they would have been. At the time in the aftermath of the mini budget, market expectations were that bank rate would have to go to 6 or 7%. Mortgage rates would be above 6% for a very long time, and it was a time of real panic. So I think the replacement of Liz Truss by the two chancellors we have now, Rishi Sunak and Jeremy Hunt, means that things are much more stable, much more, that crisis, I think, has been buried, and that is good news. And you see that in in one measure, which was sterling against the dollar. So after as you will remember, after the mini budget, the weekend after the mini budget, when Kwasi Kwarteng not only was in the middle of the adverse market reaction to it, but promised that the tax cuts he'd announced on the previous Friday were just the start, and that panicked people, currency traders, particularly in Asia. So you saw sterling drop to just above $1, just above parity with the dollar, which has never happened, and since which time you can see it's recovered quite a lot. It's still not strong. For those who are interested, what is a normal level for sterling against the dollar? If we think back to 2016 and the referendum, as well as killing off the recovery in business investment, it also sent sterling down very sharply. We had, as a result of the referendum, the biggest fall for any major currency in a short time that we've seen in the era of floating exchange rates that extends back to the early 70s. So, but before that, if you take the 10 years before 2016 and you take the 30 years before 2016, you have almost exactly the same average exchange rate for the pound against the dollar, which is 165. So we're a lot lower even now, at 120 or so than we were before. Sterling has come down quite a lot. Some people say that has been great for exporters, but you look at the export figures, it's quite hard to find across-the-board evidence of that. But sterling is much lower than it was, but it's still better than it was last autumn. I think the reason for why households, why people are still very, very miserable about things, is that we're still in the middle. We've come to the end of the first year, the big year of the squeeze on household incomes as a result of high inflation. We're into the second year of it, which is slightly milder, but it's still severe for that. So we're seeing the biggest fall in household incomes after inflation, after taxes, that we've seen since records began in the mid-50s. So if you feel squeezed, you're fully justified in that, as are the people who are surveyed for that consumer confidence index. This is the kind of cost of living squeeze that we don't normally see. People sometimes forget that you can get quite a big recession without seeing a big fall in living standards. That has not been the case over the past year or so, and it won't be the case for the next few months. So this is, this is a profound squeeze on real incomes, and the light at the end of the tunnel is there, as inflation falls this year, but we're not quite there yet. We're still in the middle of, very high inflation, and there are a number of, measures of how difficult things are. But one measure is that if you take real wages, average earnings, they are still now below where they were in the early part of 2008. So we've had essentially a 15-year squeeze on real wages. And in that period before the financial crisis, when productivity was growing by 2% a year, you'd also expect real wages to be growing by 2% a year. So in normal circumstances, you would expect real wages now to be something like 20 or 25% higher than they are. And we've missed out on that period of growth in real wages. So things have been difficult, and that's, and that is a problem. And the other thing, I realize I'm being a little bit too cheerful here, but I'll also tell you about the rise in the tax burden that is coming through, and is coming through, is upon us now, because you all know that corporation tax is going up next month. But I think less visible, but also more serious, is possibly more serious, is the prolonged stealth tax increase through income tax allowances and thresholds. The freezing of income tax allowances and thresholds. Originally, it was going to be until 2026. It was extended by Jeremy Hunt for another 2 years in his autumn statement. And freezing income tax allowances and thresholds at a time of 2% inflation is not very much. Freezing them at a time of 10% inflation is quite a lot. This is the kind of policy that was associated with Margaret Thatcher's early days, the famous austerity budget of 1981, but this has been extended over a number of years. So this is the equivalent over time of putting up income tax by 4 or 5 pence in the pound. It will bring more than 3 million more people into paying tax. It will create, another 2 million or so higher rate taxpayers. It will create another 300,000 to 400,000 people who will pay the additional rate of tax, the one that was going to be abolished by Kwasi Kwarteng. So this is fiscal drag writ very large, and because it's stealthy, we tend to notice it less. There's no announcement of an increase in the basic rate of income tax or anything like that, but the equivalent of it is quite strong. So taxes are going up. So you may think, well, the outlook must be terrible, really terrible, in the consequence of this. But it's not, it's not that bad. This is the latest forecast that we saw from the OBR, the Office of Budget Responsibility, and it's for, the most marginal drop in economic activity this year, 0.2%. 0.2% is probably a figure to think about as the closest to zero you can get. So it's a recession, but it's not a proper recession if you 0.2%. And there are lots, some economists are now becoming just slightly more cheerful. So, quite a lot of economists who were predicting a bigger recession than that, including the Bank of England economists, think that it will be again close to zero. So despite all these things, it is not that bad. And why is it not that bad? One reason is that the government support has been extensive. So government support with energy bills. You think back to last September, and the fear then was that we would, that many households would simply not be able to cope with higher energy bills. The fear was that the average household energy bill would perhaps go up to 4,500, 5,000, even 5,500 over the winter. And that didn't happen because of the energy price freeze, the energy price guarantee. We've had a lot of support, the £400 payment to people. So I think that has made the difference, and this was not intended to happen. Again, also for the government as well as for everybody else, it has been one thing after another. So the hope was that after the pandemic, you could really rein back that government support, but the Russian invasion and the cost of living crisis meant that government support had to be wheeled out again. But I think the other thing which I think is encouraging and which makes this a big recession much less likely is if we look at the labour market. We look at unemployment, unemployment rate of just over 3.5% at the moment, 3.7%. This is extremely low. I mean, part of it is linked to what I was describing earlier, which is that we've seen a rise in inactivity. We have a smaller workforce. We have intense competition for workers, and particularly some workers. But if you're going into if you've had, over the past 12 months, we've had no economic growth in the UK. GDP in January was exactly the same as GDP in January 2022. But to have been through that period and still have low unemployment is, I think, a positive sign. So that is one reason why the outlook is not as gloomy as it might have been. We also see that the job vacancies, as you see there, are coming down a little bit, but they're still extremely high. I always, the nature of advertising job vacancies has changed and posting job vacancies. It used to be that, employers would post a job vacancy at the labour exchange. It used to be for certain appointments, and greatly to the regret of the Sunday Times advertising department, it used to be that certainly executive ads and many others were put in the Sunday Times appointment section, and the Sunday Times appointment section would sometimes run to 24, 28, in a bumper week, 40 pages. These days, we're lucky to get a page of appointments advertising because it has all shifted online. And so it's easier to post job vacancies now, but that was also true before the pandemic. And you see that even with that, job vacancies are very high at the moment. We're no longer at the point where I think job vacancies exceed the number of unemployed people, which happened a few months ago and which was unprecedented. But we still have a large number of vacancies relative to the number of unemployed people. I mean, obviously, there's not a perfect match between the two, but vacancies still being high. Again, a positive sign. It shows that the job market is quite strong. It shows that employers are still wanting to recruit and in some cases are desperate to recruit. So again, that is a positive sign. It's an offset to some of those worries that people have about the cost of living and so on. The one thing that doesn't come out from consumer confidence surveys is, at the moment, is fear of unemployment. Fear of unemployment and actual unemployment is the thing that makes a huge difference in terms of the economic outlook. It makes a huge difference in terms of the outlook for the housing market as well. But that is not happening at the moment. So vacancies are still very high. We have a tight labour market. With a labour market as tight as it is, it's quite difficult to have a big recession. And also, big recessions are not like London buses. They don't, you don't get two coming along at once. We had a very big recession in 2020. Biggest fall in GDP since the Great Frost of 1709. We were never going to have another one as big as that this time. So I think we're talking about something rather different. And the way I would characterise it, the way I would sum it up, is that the last 12 months have been essentially, we've seen the economy flat. I hesitate to use the word flatlining because people have pointed out to me that flatlining is normally what happens before on those hospital dramas before somebody pegs out completely. But the economy has been flat, and I think it will be flat to up over the next 12 months. I don't think it's going to be a recession. I think it'll be flattish, and of course within that, some sectors and some people will do better than others. So I don't think there is a cause to worry unduly about things. The other very positive thing, of course, is that the energy price spike has pretty much passed through now. So gas prices are back to where they were before the Russian invasion, oil prices, peaked and fell quite quickly. And you saw that effect, coming through quite quickly, for example, in petrol and diesel prices, particularly in petrol prices, that, petrol prices went very high after the Russian invasion and came down very quickly. Now, you may ask why were we paying so much for petrol and diesel? The oil price has been higher than it has been recently. After the Russian invasion, the oil price went up to $120 a barrel. Back in 2008, it rose to $147 a barrel, and we never paid anything like £2 a litre for petrol. The difference is the exchange rate. In 2008, sterling was at $2. More recently, it's been closer to $1. And for these internationally priced commodities, if you have a weaker currency, that feeds through more directly into higher prices. It's nothing to do with tax, because fuel duty has been frozen for more than 10 years. So I think, and gas prices are coming down. So I think we are heading for a sharp fall in inflation. It didn't happen yesterday. People were surprised by that, but it is almost guaranteed to happen over the next few months. And that sounds like a big and dangerous prediction, and maybe it is. But the reason why inflation is going to fall is not because most prices will fall. I mean, energy prices have fallen, and that will feed through into some price reductions. But mostly, the prices that have been established during this period of high inflation will stay. Marks and Spencers aren't going to, revert to the pre-pandemic, the pre-Russian invasion price for T-shirts or everything else. Cadbury's aren't going to reduce the price of their chocolate bars. Those prices will stay at the new higher level. They've ratcheted up, but the fact that they just stay at the new higher level means that inflation, which measures the rate of change, of course, does not go up further. And so we're going to benefit from what are known in the jargon as base effects over the next few months, comparisons with the very high prices of a year earlier. And so the maintenance of the energy price guarantee at 2,500 will make a big difference there. So March, April, particularly April onwards, I think we'll see inflation coming down very sharply. There's a debate about how far it comes down and how quickly, but I think it was a pretty safe prediction or a pretty safe commitment by the government, by Rishi Sunak, to say that inflation will halve by the end of the year. It will be a disappointment if it only halves by the end of the year. I think we'll be down to 3 or 4% by the end of the year, and then we should be at 2 or 3% inflation during next year. And then I think there is a challenge after that. Can we stay as low as we've been over the past 25 years without the helpful effects that sometimes known as the China effect, which is borne down on the prices of goods. Essentially, over the past 25 years, until this cost of living crisis, we had zero growth in the price of goods, zero inflation in goods, 3 or 4% inflation in services, averaging out to 2% inflation. I think that's going to be more difficult in the future because the China effect is less powerful than it was. But we can talk about that. It could have been worse. I mentioned that the energy prices could have been much higher over the winter. The Bank of England thought we'd get to 13% inflation late last autumn in the absence of more energy price support. There were predictions of 15 or even 18% inflation over the winter if we'd gone to those 5,000 average fuel bills, average household fuel bills. So this could have been very painful. I think if we'd gone to those kind of levels for inflation, then I think there would have been a massive credibility problem for the Bank of England. I think people would have thought we'd lost it. They thought we were back to the 1970s. So this was a bullet that we dodged, and the reason for that was that winter price freeze kept inflation well below that. So it removed the danger of extremely high inflation. And if one is looking forward, I think there are 3 reasons I'd give why beyond those base effects inflation should be heading lower. I think we're seeing that the energy price spike from the Russian invasion has eased back quite considerably. You see it in gas prices, and some extraordinary things have been happening in terms of energy consumption. European energy consumption is down about 15% on what you would expect given the circumstances. Even accounting for the mild European winter that we've had. there have been things that have been done in Europe, much more so than here, where I mentioned the 3-day week of 1974. The 3-day week of 1974, you're all too young to remember it, but the government had had an energy saving drive there in which probably couldn't do it now with so many alternative devices, but TV had to shut down at 10:30 at night. Shops were not allowed to have lights on during the evening in their windows. One government minister suggested everybody should take a bath together, and all those things. But with the exception of the bath and shutting down the TV, many European countries have been doing those things, reducing the temperature in public buildings, reducing lighting, and taking those. And it's had a big effect in encouraging people to turn down their thermostats in their home. And that has helped, ensure that the energy price spike was quite a brief one. We're not also, there are pockets, in which the radio programs will always find it quite easy to get somebody on from a London restaurant or something to say, well, I'm having to pay my chefs 50% more than I was a year ago and things like that. But overall, wages, the story of the fall in real incomes is a story of wages not keeping up with the high inflation, which they used to do. In the mid-70s, 1975, when we had 27% inflation briefly, we had 30% growth in wages and salaries. This time, growth in average earnings has been of the order of 6% against 10% inflation. Wage settlements have peaked at 6% and seem to be on the way down again now. So I don't think we're seeing anything like the wage price spirals of the past. So we're not seeing high inflation being embedded in permanent increases in costs in a way that would worry you. And the other thing is what we saw in response to the pandemic, and it probably wasn't the brightest response by central banks, was this huge amount of QE, quantitative easing, essentially electronically creating money to purchase assets to support the economy. And although that was the right thing to do in response to the financial crisis, doing more of it than had ever been done before, 450 billion of quantitative easing in the UK by the Bank of England, which was more than the total amount that had been done since the policy was invented in 2009, was probably the wrong response. It boosted the money supply. It added to inflationary pressure, but that is over now. Money supply has slowed down very considerably, and QE is being replaced by another terrible acronym, which is QT, quantitative tightening. They're starting to reverse what they did. So I think we are heading for lower inflation. I say that the challenge with inflation is going to be keeping it as low as we've been used to over the past 25 years or so. So what does this mean for, one of the stories of the day is interest rates. And I'm channeling Sherlock Holmes here. This is the dog that's been barking quite a lot. And we've had many interest rate increases over the past year or so, more in a concentrated period than any time since the Bank of England was given independence in 1997. And so we've had 10 increases. And these increases have come thick and fast. The Bank of England Monetary Policy Committee meets 8 times a year now. It used to meet every month. And at every meeting since December 2021, it has raised interest rates. So we've moved from extremely low interest rates, interest rates never above 0.75 percentage point from March 2009 to May last year, to the kind of rates that were prevailing before the financial crisis. So this is quite a big adjustment. I think this is a big challenge for the economy to adjust to these higher interest rates. Some people will find it quite difficult, when they remortgage. Some businesses will find it quite difficult. It's a big shift. It's a big change. It lies behind the problems, incidentally, at Silicon Valley Bank, that they were caught on the wrong side of this. Most banks have benefited from higher interest rates because they've been able to raise the cost of, the cost to customers of borrowing more than they've increased rates for depositors. But that bank was caught on the wrong side of it. And of course, until yesterday morning at 7 a.m., when the inflation figures were released, I think it was a finely balanced decision about whether we would see another increase in interest rates this week. And even now, some of the notes I read from Citi analysts think that rates should not go up today. And I did a piece the other day saying I didn't think they should go up. But the inflation figure really was was a bit of a game changer. It shouldn't be really, because the Bank of England should look forward, not back. And there may have been special reasons why inflation went up instead of down. But even so, it would not be a great look for them not to raise interest rates in the context of an inflation surprise that they didn't expect. But I think we are still close to the peak in interest rates. So even if they go up today, I would expect it. It will be a small increase, and the markets have a 90% probability that rates will go up from 4 to 4.25%. But I think we're still around that 4% peak that I've thought about for quite some time, including at the time of the mini budget. So I think we're pretty close to that. If it's a bit more, that's no great harm done. But I don't think they're going to go up by much more. That was the signal we had last night from America's central bank, the Federal Reserve, and I think it is what we should expect here. There is a danger of overkill here, and the danger of overkill, I think, is accentuated when interest rates have gone up thick and fast without any time to assess the impact of those increases. You're doing one after the other, and without, as I say, assessing whether it's damaging the economy, whether it's having much the effect that they want. So I think that is a risk. The other risk, of course, is that we have to keep our eyes open for more shocks, more horsemen, more shocks and surprises, which could come along. The nature of these things is that I think one of the things we've learned is that things that people have warned about, including pandemics and so on, and we're high on company risk registers and also the government's risk register. Maybe we should stop ignoring those so much. So maybe we should listen more closely to those warnings, to those risks, and so on, than we did. And the government had high on its risk register was a pandemic, but they had a flu pandemic, not a new virus. But we should always be aware that there are dangers out there, and it doesn't take long to think of many dangers. China, Taiwan, other things, and so on. The banking system, which I mentioned, but I'm not so worried about. So we should think about those things. We just have to hope for calmer waters. Things are never as calm as at the time as they appear. You look back to pre-2008. It seems like a halcyon era when we didn't have anything at all to worry about. But in fact, at the time we had plenty to worry about, and it's the same at any period. Things. Nostalgia always plays tricks on you. But I just hope we can have at least a little time without too many major shocks to knock us too badly off course. And on that note, I'll just finish by updating you on my SKIP index, which is one of the more important global economic indicators. It's my own proprietary economic indicator. It's based on the number of builders' skips on my street. And for those of you who don't know, that when there are no skips on the street, we're in recession or there's no growth. When there are 2, the economy is growing in line with trend growth, and when there are 4, it's an unsustainable boom. And I can tell you that the pandemic played havoc with the SKIP index. When the pandemic first broke, nobody wanted a builder anywhere near the house, and there were no skips on the street. And even using my reserve power as a statistician, which is to be able to count 2 hippo bags as 1 skip, I was unable to get a score on the index, so we were 0. And then, quite quickly, everybody decided they're going to be working from home forever, and wanted an office in the loft or in the garden or somewhere. And at times we had more than 4 skips, and I got quite worried that things were getting out of hand. But I can tell you that things have settled down now. We're down to 1 skip in the street, along with a spectacular bit of scaffolding, and it happens to be my neighbour. So I think we're there with the economy certainly not falling off a cliff, just about hanging on, flattish, but no worse than that. Thank you very much for listening.
Lovely, thank you, David. I was deeply worried we weren't going to get skipped. time. We have half hour or so for some questions. If you'd like to stick your hand up, I have some colleagues here with some microphones that can come and dig you out. Would anyone like to raise a question?
Got one over here. Hopefully it works.
Thank you very much for a brilliant presentation and pulling things together in a way which we never normally get from anybody. So thank you. I was particularly taken by your slide showing the OBR's prediction of growth for next year, so rising to 1.4%. So one observation, one comment. The observation is OBR doesn't typically get it right. It does tend to revise uncertainty, et cetera, So what do you think is the one or two key things the government needs to do, if it's got its eye on the ball, to make sure that we do get close to that 1.4%?
Yeah, I mean, the forecasters are usually, and economists in general, are usually criticised for being too gloomy. But the OBR's record, since it was set up in 2010, it's tended to be too optimistic about economic growth. And it's more optimistic than most forecasters about next year, including the Bank of England. So a more typical forecast for the economy is, pretty flat this year, pretty flat next year, rather than the bounce that the OBR has seen. I think the key to your question is I suppose the question that was posed by Liz Truss in the brief period when she was Prime Minister, which is how do we get back to 2.5% growth in the long run? 2.5% is not a magical figure. 2.5% is exactly the growth rate, the average growth rate that the UK has had since 1945, but it's split into 2.7% a year up to 2008, less than 1% a year on average since then. So how do you get back to what used to be the norm? And I think it's a range of things. You have to think about this. How do we address the prolonged weakness of productivity? If you've got productivity growing by 2% a year, it's not hard to get 2.5% economic growth. And so that means that we do need more business investment. Maybe the capital allowances announced in the budget will offset the rise in corporation tax, but maybe they won't. Maybe we need more than that to get business investment going. The thing about UK business investment is that it's almost everything you throw at it doesn't seem to make much difference. So even those dramatic cuts in corporation tax didn't make any difference. It's on average, and it usually stays pretty close to the average. Business investment in the UK is about 10% of our GDP, 10% of national income. Most competitors, it's 14%. We invest a lot less. If we want productivity to improve, we need to invest more. And I don't think we've cracked how to do that, really. There's something there. We need, to think about skills. We need to think about not just getting people back into the workforce, but how they can cope with a higher level of skills once that, how they can generate a higher level of skills when they're in the workforce. We probably don't spend enough on training. Again, I think when Rishi Sunak was Chancellor, he did a speech, and one of the things he set out was that in the UK we spend half as much on quality in-work training as most of our European competitors. And, again, there may be long-standing reasons for that. It may be that people think that the more they spend on training someone, the more likely they're going to get poached by somebody else. But there is an issue there. So these are quite long-term things. I mean, if you want to get to 2.5% growth, back to 2.5% growth, you have to address these things. The OBR's forecast is and I would say in addition to that, you have to press on with improving infrastructure. You have to make sure that innovative UK businesses are properly rewarded. And we've got a situation at the moment where a lot of successful UK businesses are deciding to list in New York when they float rather than listing in London. And some of that is due to the fact that there doesn't seem to be enough equity capital in Britain. It used to be the case that pension funds and insurance companies invested a high proportion of their portfolios in UK equities. Now it's a fraction, perhaps 5%. And you have to think about the pool of capital which allows companies to expand. So there's a lot of big long-term things. The short-term reason why the OBR is more optimistic than most others is that he thinks that there's going to be a big fall in the amount we save, and that will bring forward a lot more consumer spending. And the consumers will spend what remains of their savings that they built up during the pandemic, but also in the long term save less than before. And I think the argument against that is that, you know, if saving has been higher during a period of near zero interest rates, you know, higher interest rates, particularly higher interest rates that don't look so negative in real terms once inflation comes down, that may provide an incentive for people to save and to hang on to their money, and also, you know, the fear of something else. But it's a forecast. It's an optimistic forecast. So, but the challenge is to have stronger growth in the medium term, and I think it is quite a big challenge.
Okay, thank you.
Lovely. Do we have any other questions out there at all?
Morning. Thank you so much for the excellent discussion today. You mentioned flattish, not flatlining. You mentioned some sectors will perform better than others in this next 12 months. Which are your predictions for those sectors?
Yeah, I think it's a good question. If you're looking at, you know, for example, prospects for manufacturing industry are not great over the next 12 months. If you look at, you know, predictions from the industry bodies in that sector. But even within manufacturing, there'll be some bits that come back more strongly than others. So car manufacturer fell to rock bottom as a result of chip shortages and perhaps as a result of Brexit, but is in a period of recovery now because those supply difficulties are easing. You know, and they needed to. You know, we had car manufacturing in the UK falling to its lowest level since the 1950s. You know, there's only one way from there, you would hope, which is upwards. But within, you know, a lot of manufacturing sectors are going to struggle. I think within the service sector, retailing is not going to do particularly well. You know, when the final lockdown ended in spring of 2021, I think, you know, retailers just sort of sat back and, you know, and they thought this is lighting the blue touch paper. We just wait for, and you know, for one day when there were queues around Primark in Oxford Circus, or near Oxford Circus, people thought, well, this is it now, you know, everybody's going to be racing to the shops and so on. But in fact, retail sales have done nothing since the lockdown was lifted. It's almost as though we spent all we needed to do online. The online balance has settled down, so, you know, pre-pandemic, sort of 17 or 18% of our purchases were online. It rose to 35% during the pandemic. It's settled down to about 25% now. But even if you take online and physical retail together, you know, it's struggling, and there's nothing to suggest that struggle is going to ease. So I think we're looking for professional services, business services are doing well at the moment and will continue to do well. And those are the sectors which I understand, and you will learn more about this than I do, where AI is making a big difference at the moment, and people are embracing AI more than perhaps you might have expected, you know, it to be in factories and so on. But business and professional services, I think, you know, things like experiences, travel, and so on. Once inflation starts to ease, I think people are going to think that, you know, this is time to do those things that they couldn't do for the last 3 years for various reasons. So I think that will be okay. But I think it'll be a very mixed picture. You know, I think, you know, it's always the case that, you know, you talk to some industries and you talk about recession as being as a backward-looking thing, and they will say we're still in it. You know, so different parts of the economy will click into gear at different times and different paces. But thank you for the question.
Anyone else? So.
I'm going to have to pass it over there, isn't it?
Thank you for your presentation, David. You did write a piece yesterday saying that you felt that interest rates should stay at 4%. Given the change in inflation that was announced yesterday, is that still your opinion that that should be the case? Or, if yes, why? And if not, why not?
Yeah, I mean, if I were on the MPC, I would say we need to look through that surprise increase in inflation and look towards the future. And one bit of the future was that, you know, from their own forecasts, is that if bank rate were to stay at 4%, their forecast in February suggested that inflation would be below 1% in 2 years' time and 0.2% in 3 years' time. So you can take it from what they say. I think, as I say, there's a danger of overkill from too many rate rises at once, you know, too many in quick succession. I think the impact of the banking tremors that we've seen is not going to be that we see a banking crisis, but there will be a tightening of lending standards, and that will also impact on the economy. So I think they've just got to have the courage of their convictions and think that inflation is going to fall. Yesterday's inflation figure was an embarrassment and is difficult, but look to the future. So I would still do that. And as I mentioned, the money supply, which is a worry to some, and was a worry to some when it went up a lot as a result of QE, is now on some measures negative, which would point again to low inflation in the future. Pay settlements seem to have peaked, and so does average earnings growth. So for all those reasons, I think they shouldn't raise, but I suspect they will. Yeah, but that was that piece, I can tell you, was an example of what you might call the commentator's curse, which is the commentator's curse is when a cricket commentator is just saying, well, so and so is going along marvellously, is bound to get 100, and then he's out next ball. Doing a piece which appears on the morning of the inflation figures coming out. I mean, it wouldn't be so bad if the ONS didn't release them at the ungodly hour of 7 a.m. So by the time most people read that piece, they would already be aware of the inflation figure in a way that they wouldn't have been. I mean, I can remember a time when all official figures used to be published at 9:30, which is better. At least people could have read the piece before getting the inflation number. And even before that, 11:30. 7 a.m. is pretty punishing. And I say that was the commentator's curse on that particular piece. But anyway, thanks for the question. No questions from this side of the room, but that's fine. And you all want to get off and get on with things. But time for a couple more. Any questions? Well done. Yeah.
Thank you, David, for a lovely presentation. On a scale of 1 to 10, post-pandemic, how would you rate the Conservative government's performance, given there's always some room for improvement? And do you fear a Labour government going forward for the economy?
Yeah, I think the problem with the you can debate the responses to the pandemic, and the criticism that we had of the government under Boris Johnson was that it was too slow to respond. Not that it was, in pretty much every case, that they. And I don't think that particularly came out from the famous WhatsApp messages, but Boris was, either doing his Shakespeare book or something, or resting after winning the election, but he was not engaged at the start of the pandemic, missing all those Cobra meetings and so on. But the response was a bit chaotic at the start. But I think the problem I would have with the Tories recently has been that. We've had the same party in charge since 2010, but there has been zero consistency when it comes to tax in particular. So, at one time under David Cameron and George Osborne, getting the corporation tax rate down to the lowest level in the G20 was a priority, as was taking people out of tax by raising the personal allowance by more than inflation, raising it to 12,500. Both of those have lurched into reverse, which had there been a change of party, you would have said, well, that's just, they're using it as a political football. The Tories are playing political football with their own policies, and I think that has been wrong. There's no consistency there. So, and I think people have found it, and businesses have found it difficult to judge, what this government's philosophy is, if you like, and what its approach is because of those changes. I think Labour, there'll be some things that Labour will change, and maybe there'll be more things that they will change than we know about, because quite sensibly, if you're 20 points ahead in the polls, you don't tell people more than you need to. But the fact that the only thing that they could find to criticise in the budget was the removal of the lifetime allowance on pensions shows that the differences are quite small between the parties, and the Labour is still quite worried about being seen as too left-wing, too dangerous, too risky for the public finances. I think Rachel Reeves and Keir Starmer are about as centrist as you could get, you know. And I think those influences from the left have gone. So I don't think business has an enormous amount to worry about, but I'm certain there will be things that, and that, you know, always happens, the things that happen beyond an election are things that we didn't know about before. So you think about probably the biggest thing, economic thing, that the Blair-Brown government did, which was Bank of England independence. That was a surprise when it was announced 5 days after the election. You know, it had been something that they would look at over time in the run. You know, they said in the run-up to the election, but announcing it quickly. And it was same with, you know, Margaret Thatcher in '79. Most of what she did, and most of what that government did, was not prefigured before that election. You know, we have to be prepared for things that we don't know about. But I don't think there is need for enormous panic, as there would be. You know, I think everybody would have been quite right to panic at the idea of Jeremy Corbyn and John McDonnell getting their hands on the tiller. You know, so but thank you.
We have time for one more question. Jackson.
Thank you for the presentation. One of the factors on the present situation has to be with concentration of production in a couple of countries, and that led to the disruption of the supply chain. Are we learn our lesson? Are the government and the businesses trying to change that trend? Can you see any measures going in that direction?
Yeah, it's an interesting point. You see this, you see the response to that. You know, particularly, I suppose, talking about China and the concentration, but also, you know, we found ourselves vulnerable as a result of the war in Ukraine, you know, with gas supplies and so on. I mean, one reason why the UK has been quite vulnerable in all this, in energy shock, is that we are much more gas dependent than most other countries. Even though we didn't take any Russian gas, the gas is priced internationally, and you know, something like 43% of our primary energy use in the UK comes from gas, and even, you know, in most of the rest of Europe, it's just over 20%. So the dash for gas of a few years ago made us more vulnerable to this. But also Ukraine, you know, there are lots of things that we probably didn't know about that we're getting from Ukraine. You know, Mariupol, which suffered devastation, was a big source of components for the motor industry, for example. You know, wiring looms and things like that. That was the thing came from there. So I don't think you can divest. You can insulate yourself completely from that. There's always been a lot of talk about reshoring and getting things back into, you know, away from places like China. And if you look at the, you know, America's Inflation Reduction Act and all the subsidies that have been provided there, I think there is a pretty specific aim there about getting supply chains back into America. And Europe is making something of a response to that. We in the UK are not doing that at the moment. And every time there's been talk of reshoring, it really doesn't come to much at all. So we haven't seen any of that. If it had, we'd have seen a revival of manufacturing rather than its decline. But I think it is a good point. And, you know, things like our dependence on certain countries for rare metals, which are crucial to, you know, electric vehicles and things like that, is a concern, I think, you know, in a way that, and I think it's exposed those concerns. We saw quite recently our vulnerability for some fresh food, you know, to weather conditions elsewhere in Europe and possibly Brexit as well. So I think it is a concern. And I think we've got used to the idea that a globalized world can deliver you everything when you want it immediately and just in time. And now I think we've learned it's a bit more complicated than that. So I think you're right to flag it up. I don't think politicians are doing enough about it, except maybe in America, where there's quite a drive going on there to reduce dependency. But it's a good point, yeah. Thank you.
Thank you very much, David Smith.
Thank you.